Well, hey everyone, welcome to the Wealth Investment Network podcast. I'm here with my good friend from Austin, Dan Kryzanowski. Thanks for joining us, Dan.
Awesome, Brian. Great to be here today.
So, Dan, the reason I wanted to have you on is you're out talking to investors all day long professionally. So, what do you see investors are looking for in the current environment?
Yeah, some of it's the same, some of it's new. So we had the benefit, I'd say, both formally via a survey and then informally, kind of what I naturally have been doing for probably the past decade, but a little more prescriptive over the last 5 or so years, has been talking to fellow accredited investors, fellow passive investors, alts, all the names for us. I think we're all looking at the same. We feel that at least a certain percentage of our portfolio should be outside of the stock market and bonds. So, with that theme, I think has expanded to a greater percentage of the accredited population. In addition, just for portfolio diversification, I think the net result of COVID is, no, I'm just not going to sit blind and have a 60-40 stock bond. I think the inflation headline in some ways has helped that a little bit when your bonds or CDs are earning 1 or 2%, or even the best yield on stocks are 6 to 8%, but the stock went down 10%. People start to recognize that this, your purchasing power parity is going down, which at least for us here in Austin, housing is an obvious component, and you see that a lot across a lot of parts of the country. Or I'd say parts where folks are net moving into, they're noticing that. So with all that said, the most common asset continues to be real estate, where folks are investing passively. Ever since Mark Twain said, buy land, there's no more of it. That's still true. And what goes up on the land in certain parts, whether for zoning and other reasons, is also true. There's only so much housing, even when you build high, to go around at this point, or multifamily or industrial, et cetera, self-storage, different asset classes. So, with that, I think more folks, whether as part of their 9 to 5 or what they do now consciously in the evening and the weekends, is becoming educated on what else is out there. So that's just a high level. And I say that this touches everywhere from, somebody in their 20s to even your doctors, your 6-figure professionals that want to retire early. I know a lot of us here in town have friends that want to, whether it's Dell, Microsoft, are looking to retire early to be both a passive and to be an owner. So for me as an alts guy, this I think is very positive momentum. And for me as a real estate guy, I think it's a double win also. It's not as volatile as, say, something crypto, NFTs, et cetera. So, right. With that, that's the, I think, blanket statement that we've heard, and the sample size has grown, tremendously. So with that, what do folks want to invest in? The first thing we heard is, I joke and call it the boomer fund because it's the monthly check in the mail. Right. No, we're not going to cut checks, et cetera, but we'll call it at least an ACH. But I think there's a certain level of comfort here, and for a few reasons. One is, as the music slows down a little bit from everybody just making 20% plus on every deal. Folks want to see, hey, is this an honest deal? Obviously, the diligence, and when the check moves, that's when things get real between you and the operator of the property. But some folks say, listen, I want to invest $500,000. Let me just come in at $50,000 to learn about the sponsor, to learn the process. And, many times this might be the first time that these folks have gone online to create an investor profile, maybe to have a second tax ID from a self-directed account, et cetera. This is very new for folks that, are book smart, educated, probably, 7 figures in the bank one way or another, et cetera. But this is just a little bit different. So I think the peace of mind, whether it's that monthly or quarterly distribution, seeing that come into you is a warm and fuzzy. So I think especially now with, once again, purchasing power parity, purchasing power getting higher, inflation still, relatively high, folks want to see that imminent return to see, hey, does this work? So that's the first thing I think for folks coming in the door, folks that are getting to know a sponsor or a syndicator, meaning the person that's raising the money for the real estate. they want to see that because once again, I call it on the private side or the retail side where we are, you don't have that daily liquidity like you would in a REIT. So this is something for folks to get comfortable with. So this is one strategy that I think not just now, but over time is going to be attractive to folks, but I think especially a bit more now. Next up, the other side of that is folks say, hey, whether it's inflation or self-directed IRA money, I don't need dividends. I kind of understand how this game goes, or I purchase houses. My buddy has put the concrete in the ground, built something. I'm okay with that. And you say, I double my money, and if we'll throw on the inflation card and say, hey, if another zero goes on inflation, cool, then I 10x or 20x my money. Probably won't exactly play out that way, but that's the mindset of some folks. Or, hey, like Austin, it's a very hot market. Maybe I get a 3x over so many years. Just throwing some of these out there, relatively speaking. But with all that said, this is the other side, where either folks just say, yeah, I feel good about this strategy, this sponsor, and I want to set it and forget it for 5 years, for example. Let me go into a development. So two sides of a coin that I think, have been around, will continue to be around, but also both very attractive now. In the middle, 2020 is the obvious year because of COVID, but, over the last 2 or 3 years, there could have been periods in one's life where it's been challenging, to put it nicely. And these folks say, wouldn't it be great if I just closed my eyes and woke up and I had 20% return? Yeah, that'd be great. And you know what? This is a strategy. It's been out there. Some people might call it hard money loans. I prefer to call it a bridge or pref. And as you look at the sponsor in the cap table, many times these are not, I'd say the riskiest. If you're thinking of Legos, you're not at the top of the pyramid here. You're down a little bit, which is healthier from an investment standpoint. So I share because I think folks, and it's not because they need every last dollar. As you get to know sponsors and their mindset, a lot of them have built their millions in their portfolio by always keeping a few million on the side so they can get the debt to get the next deal. It's kind of the way the game works. Not a super surprise, but not common knowledge. So once again, if folks have played this as a sponsor, as a developer, they need the short-term money. I'd say a wise sponsor is going to thank his or her investor base. So, with that, this is the short-term sort of money that it's not the monthly, but it's not a long-term. It's kind of in the middle. And, as we can see, a blink of an eye here, we'll be at the end of the year and thereafter. So this moves pretty quickly. So from strictly a passive standpoint, that's I'd say the 3 primary pieces of feedback that we received.
Right. Yeah, so we talked about this a little bit. I mean, it is more of a sponsor. It's always been curious to me that people were as concerned about cash flows because, you're really after that yield. But I can understand from an investor's point of view, this isn't generally a new asset class for a lot of folks. And so while they're developing a relationship with a sponsor, being able to have access to regular liquidity probably does provide that peace of mind that this isn't some person that's going to run off with my money or whatever the other concerns are. How would you say people are generally thinking about that? Is it primarily a peace of mind issue, or are they really after, hey, we're going to do something with those cash flows? Because every sponsor's brochure says, hey, don't expect to get access to the money until however many years from now, depending on what the business plan is. How are people thinking about that in general?
Yeah, I mean, I think it depends on their stage in life and their mindset, frankly. Across the board, whether they come out and say it or not, I think principal protection is big. Nobody wants to lose their principal at any stage of life. That said, as you said, people, particularly if it's an existing asset, folks, I think would get very hesitant if there was not payback. Obviously, development is a different story because you still have to build something for people to move in and pay rent, for example. So what you see here is principal protection, but then also I know a fair number of folks that this supplements their Social Security. They may have $1 million equity in their house, take a place like Austin or in the Bay Area, but they don't want to tap into that. They don't want to do a reverse mortgage. They said, no, here's, 100 or 250,000. I like getting that check for a few hundred or 1,000 or so a month. I can live very comfortable off of this right now. So, that's one. I think the second one for folks kind of in the hustle and bustle, middle age, a few kids, etc. You just, maybe it's every 3 months, frankly, you actually look at your checking account. It's just good peace of mind that this is here. And why is that? Because, there might be a different part of Texas, or for our friends in multifamily, maybe it's industrial or self-storage, a different asset class, or somebody with expertise in residential that you really want to trust. And once you have that initial check with them and you receive those returns, that conversation around the dinner table when, you and your spouse are talking at 10 at night and you finally get a moment, but you are talking about 6 figures or maybe 7 figures, it's an easier sort of discussion when it can be like, hey, here's these folks, we went with them and here's what they said they were going to do. And this is exactly what they did.
Right. Okay. So Dan, I know you said you have, or at least we've had conversations about this, but can you tell our listeners about what licenses you have? And then also, what role does a license play for these alts? Because it kind of seems to me, outside looking in as a sponsor, like we're kind of shoehorned into the FINRA industry. And, can you talk a little bit about that and your experience with that?
Sure. And I'll preface, I'm not a CPA, I'm not a lawyer. I don't work for any of the said entities. But like anything, receiving a license tends to give you benefits, opening certain doors. At the same time, it may close certain doors. So there's a trade-off, frankly. But generally speaking, I mean, at the highest level, when people hear Series 7, which it is, sometimes it's more of a generic term, which means, hey, I'm licensed. I know a lot of us, when we came out of school, whether it was with, a Merrill Lynch, maybe one of these financial advisors, you were probably licensed. And also, if you're frankly in a different career, you probably had some licenses going forward. In my opinion, licenses are much more common, if not required, when you're at this institutional level. So you work for a Fidelity, you work for a Vanguard. In turn, you manage institutional money for a family office. These are just some of the circles that the folks play in here, from one broker dealer to another, going from ABC Real Estate to a financial advisor that has Charles Schwab as their custodian. There's a certain reason, and I think, for the investor, it's net beneficial, the amount of diligence that goes into some of this. That said, there is also, it could make it a little more challenging, I think, putting on my investor hat, for the investor to find the best deal on their strategy. For example, are you going to find the best self-storage operator with one of their publicly traded REITs? I'm not sure. I don't know if that's going to get you the best net return. Particularly when you consider distributions versus dividends, 1099 versus K1, the ability to speak to the actual person that is managing the property. You're probably not going to get that with the publicly traded shop, with something institutional. So I share all this. Broadly, this is part of the ecosystem, and you have to think whether you're an investor, or as per your profession, do you want to have certain, I think, regulations, certain timelines that go into this? Once again, it opens up certain doors and it doesn't. And I think if you have a large institutional fund, you're on fund 4, it's $1 billion fund. You can talk to some pensions, you can talk to other institutions. Yeah, definitely you're going to benefit from being licensed. You're up and coming here. Maybe you're on your 6th property, whether it's residential, small, multifamily. Not a huge benefit to being licensed, or say standing up your own broker dealer, because you're competing with all the big guys. That's why I talk so much about kind of the broad world. And then in addition, there's, whether it's from marketing, I think flexibility of who one may want to represent. Like anything, when you're the owner of your company or companies, you have flexibility within that. When you're licensed, you're effectively an employee, at one aspect or another, and you have to respect that. So that's another sort of trade-off.
Okay.
What?
Yeah.
What other?
Go ahead, Dan.
If I could just go in full circle back to where it is beneficial, sometimes certain product types, and this is a bit of the weeds, but it does go back to part of our initial survey that we had in the year is certain products which might be considered new to many of our listeners, such as a Delaware statutory trust, the DST. So let me preface what's a DST. If let's say you have a property you sell, you no longer want to own and operate, which means you cannot 1031 exchange, but at the same time, you do not want to pay taxes. In the middle is a DST. I like to say it's the best of both worlds. Without going into much detail, certain entities have to have certain licenses and such to offer something such as the DST. So once again, I think broadly, if you're hyper niche in a strategy and it requires being licensed, then go after it. If you're not as much or it's tangential, probably not.
Yeah, one of the things that I observe, and we attend a lot of the same meetups, but sponsors at some point in their career have to choose, I think. Mm-hmm. Are they really going to focus more on operating projects or kind of on the operations side? Or are they going to focus on, helping to raise money for deals? And that kind of ties in a little bit with the licensing discussion. But can you talk a little bit about, your experience having kind of played in both worlds? How do people think about the world as a sponsor versus how did they think about the world if they're really more on the capital side and helping to raise and organize money for another sponsor's project?
Yeah, absolutely. And, just to preface, if you're on the institutional side and you are raising money, there's a lot of benefits to being full-time, W-2'd, selling the suite of products. I started my career at Merrill Lynch, for example, albeit on the trading floor. If I was on the private side, I would have been limited to this, but it would have opened a lot of doors because people are going to answer a call from Merrill Lynch, for example. That said, if you have a niche self-storage play, you're probably going to be considered in the eyes of the institutional world, a mom and pop, somebody smaller, although it's not officially retail. I like to call it retail because it's generally smaller dollars. In my opinion, more intimate relationships, even if you are doing a 506c offering versus a 506b where you need the one-on-one. I still think you have that warmth of, much like for anybody that's invested in an early stage startup, you do have that one-on-one relationship with the team that is operating. So, with that, I think it's partially a personal preference. Secondly, some folks they enjoy representing a particular sponsor or a particular strategy. It's a fair conversation to look to be one of the general partners, one of the GPs. Like anything, when you are the CEO, when you are the lead of your company, you can raise money. You have that GP, general partner exception here. So many folks that particularly tie in with a particular sponsor or strategy, or frankly, start as a capital raiser and go on their own, become a GP to have this GP exception. So you can fully represent your brand and raise from there. In the middle of these sort of worlds, I think are folks that don't want to work for, say, the big box company, but definitely see the sort of benefits just because the amount of product that comes through. We talked before maybe about the peace of mind to certain investors. In here, you may stand up your own investment advisor. You become your own RIA. So, which gives you more liberty. I don't want to say to be a free agent, but, ideally to do your diligence and say, okay, whether I have somebody, an operator in storage, in residential and industrial and multifamily, and I can then, much like your investment advisor would, to say, hey, here's a strategy in your stock and bond portfolio. Have the liberty to do that with alts, with private real estate. So if that's where your comfort level in calling is, you can go down that route. And then, it's more of a question if you're doing it for fees and commission or for asset under management. And that's, a deeper sort of discussion. But Yeah, I really think it's wherever your comfort level and ultimately where you are going to resonate the most with your audience. I think there's three very different avatars from a career perspective. I started off big box, which I got some good corporate muscle and mindset. I've done a lot of mentoring where I've unofficially have been a middle person, but that's just been kind of in kind connecting. But, ultimately I feel there's true benefit of having the one-on-one, sort of relationships.
Okay. All right. Well, thanks for the discussion, Dan. How do people find you if they want to learn more about, your services or some of the private opportunities that you have access to?
Yeah, absolutely. So LinkedIn is great. And please said, you heard Brian and Dan chatting today. Send me an invite. I love the one-on-ones. That would be great. Some of the, I'd say, broad strategies that I reference are similar to what BV Capital is offering at the moment. So that's bvcapitaltx.com. We have an indication of interest form, whether it's BV or another sponsor. I think it's just fair for both sides to fill that out, to share that you're accredited, what you're looking at. Maybe it's a strategy you're looking at that deal is in the pipeline. It's just not known yet. So I think it's a good mutual win-win to do that. And, Brian, one thing we didn't talk about, but a lot of folks know me for is I've been around the self-directed IRA and solo 401k world.
Right.
And without going into deep detail, a blanket statement I've shared probably 100 times over on podcast is that, did you know you can use your retirement dollars to invest in private real estate, in startups, personal loans, invest in female founders, et cetera? You can do all this with your old 401k, your rollover IRA. So, with that, I had an association with Rocket Dollar. I think they have a great knowledge base, rocketdollar.com/learn, that I would suggest. And then happy to dive in detail, whether you're on the strict LP investor side or if you're raising capital, to share how so many capital raisers have been so successful just from, frankly, knowing how to share that one sentence. Did you know you can use your retirement dollars to invest in my next deal?
Right. Yeah. No, Dan, we'll have to have you back on to talk about self-directed RAs. That's on my roadmap of things to talk about.
Lovely.
So
awesome.
All right. Well, thanks again for taking the time, Dan.
Thanks, Brian.